All right, ladies and gentlemen, welcome to a new masterclass from People's Capital Group. My name is Aaron Fragnito, and tonight we'll be speaking about how and why to create a fund of funds. We try to teach a masterclass every single month here at People's Capital Group, although sometimes we get busy with new offerings, which we're going over with a new property. But tonight I'm going to teach something that is becoming a bit of a buzzword, fund of funds. And I encourage interaction here. I see a number of people jumping on. So let's see if you've heard about fund of funds. Write in the chat for me if you've ever heard of a fund of funds. It's a buzzword we're seeing in the industry these days. And so write in the chat, have you heard of a fund of funds before? Yes, no. Uh, Maybe, not sure. It's something that is becoming more of a buzzword, and it's an interesting strategy to allow people who have relationships in place. If you have friends or family members asking about your real estate investments, and you've always thought, hey, you know what? I refer people to operators I invest in who I like, know, and trust, but I don't ever get anything for it. And that's not really fair. And I want to get an envelope full of cash, but that's actually not legal. So this is a legal way to work with some of those relationships you have in place of other colleagues in your network that want to invest in real estate like yourself, and for you actually to be compensated properly for making those connections. So I see here in the chat, a number of people, yes, have hey, Gail. Hey, Rich. Yep, have heard of fund of funds, which is great. So yeah, put in the chat. Have you ever heard of fund of funds before? Yes or no? It's an interesting concept that we're seeing more of these days. Get right into it here. Quick disclaimer, this is not a solicitation for funds for non-accredited investors. PCG Fund 4 is only open to accredited investors. So my name is Aaron Fragnito. I'm one of the owners and founders of People's Capital Group. Seth Martinez is my business partner, and we've been helping people build and preserve their wealth in New Jersey real estate since 2013. Seth and I have completed about 280 transactions together throughout this state, and I have about an 83% reinvestment rate after a liquidity event with investors. We have about 100 investors in our network that consist of primarily family offices and high net worth individuals. And we strictly focus on the North Jersey market. We've been doing this over 10 years and are vertically integrated with an in-house property management company. But I wanted to put this presentation together because I have a lot of investors that come to us and say, hey, I have friends and families and colleagues and coworkers that ask me about my real estate investments. And I want to refer them to you, but I want a little piece of the action. And, it's very limited what the SEC allows us to do. And if you're not a licensed broker dealer, you actually really can't get a commission for referrals necessarily. It's a bit of a gray zone. So this is a way that we can work with different people in our network to help you create a fund of funds, see if it's even a fit for you as a fund of fund manager. We'll talk about how to raise private capital tonight. And also, we'll go over People's Capital Group and a current private offering that we're putting out to investors that fund to fund managers can actually use to create and launch and build and invest wisely into our next opportunity here using their fund of funds. By the way, if you have questions as we go along here, put them in the chat or the Q&A. I encourage interaction. And absolutely, yeah, that's right. It's a great way for investors to invest in properties without having to do the work. That's it, Gil. You nailed it. So put those questions in the Q&A, or if you have any technical difficulties, you can't hear me or see me, let me know as well. So People's Capital Group is offering qualified investors an opportunity to learn how to create a fund of funds, raise private capital, and invest into a Class A, fully managed, mixed use building alongside People's Capital Group. So I've raised about $20 million in my career. And we built a nice system of working with investors to explain to them investment opportunities and help them get into real estate and raise private capital to buy these buildings. And now we want to express how we do that to other individuals and how to also create a fund of funds. It's actually much easier and more affordable than you might think. There's companies out there that can really help you do it, and it really only takes about a week actually to get up and running. Maybe one maybe 2 weeks at most. So let's dig right into it here. So what is a fund of funds? So it's a legal way to raise capital. It does not violate any SEC regulations. It's a way you can actually work with people in your network to raise capital, to help them invest in real estate, and get paid, compensated very nicely for your efforts and your relationships. A fund of funds is a legal way for current real estate investors to invite their colleagues to invest in real estate alongside them and be compensated for providing the opportunity. So, how do you earn income on a fund of funds? Well, there's actually three streams of income here for fund of fund managers. Uh, First of all, there's two sets of fees normally fund of fund managers charge. First of all, the AUM fee, assets under management fee, that's generally 1% of capital raised. So, if you were to raise, say, $1 million, most fund of funds are around 500,000 to $1 million in capital raise. $1 million raise would equate to about a $10,000 fee per year. That's an annual fee a fund of fund manager would charge. In addition to that, normally you would charge a one-time due diligence fee. That's about 2% of capital raise. So on a $1 million raise, you'd be looking at about a $20,000 one-time due diligence fee as well. Then the majority of the income is actually earned, of course, through the profits of the investment. So 90-10 split is generally the split you'll see for a fund of funds manager, 90% going to the limited partners, 10% going to the general partner. That's you, the fund of fund manager. And so let's say you have $1 million investment, generally, 5-year investment, you're looking at about a 2x return. So you essentially double that money over 5 years. So $1 million creates about a $1 million net profit. Now, then you have some fees. Most of the fees actually, which are going back to you. There are some other fees here for if you team up with a company. I'll go over in a second here on the other part of the slide. But let's say out of that $1 million profit, you net 915,000 or so. You would get 10% of that. So that's another $91,500 in your split of the profits as a fund of fund manager. So all said and done with that $10,000 annual fee, that $20,000 one-time due diligence fee, and that $91,000 or so on the back end, you're looking at a little over $150,000 over a 5-year period being a fund of funds manager. And that does not include any investment you would make as a limited partner into your fund. Now, of course, limiting your risk as well. There's no signing for debt. There's no hands-on management. There's no managing the management company or underwriting tons of deals. We'll look at 100 deals to buy one. We bring to our fund of fund managers a well-written institutional level underwriting deal with a very in-depth deal room and essentially all the work done for you so that you can determine that this is a good fit for your investors and your fund. All the day-to-day activities are done for you, and we report back to you as an investor and the manager of your fund. Your risk is limited to your investment in your fund, which is not required, but encouraged. We do find it much easier to raise capital when you have some skin in the game. Even with us, we invest in our own deals, right? And it's important to have some skin in the game. Investors want to see that, especially on your first few funds. So you'll be far more successful in raising capital from your colleagues if you also are putting some investment into your fund as an LP, a limited partner. And that investment will, of course, earn additional returns, whatever the LP investment earns, right? So the $150,000 or so I was speaking of a second ago is really just on the GP side. You would earn additional returns if you made an LP investment as well. And but let's talk about how complicated this is, how much time it takes, how much money it takes to start a fund of funds, right? A lot of people think, oh, it's ridiculous. There's legal documents, there's marketing documents and so on. There's a back office, that you need to have in place. Actually, there's companies in place right now that can help you do this, and it's a lot less than you think. We prefer working with TribeVest, TRIBE Vest, TribeVest. And there's other companies out there as well. I think there's Avestor. That's another one. They're a little more expensive. We think TribeVest is a better deal. And it's about $5,000 to start your fee. That includes all the legal docs, all the required resources to get you up and running and taking in capital. They can do it in about 5 days. So pretty quickly, pretty affordably. And then running your back office, your bookkeeping, your tax filing, all the distributions, the platform for your investors, all that. It's about $2,000 a year for 10 investors. If you do more investors, it can be more. It goes to about 4,000 for 20 investors or so. But that's really not bad. I mean, we'll pay up to $20,000 to launch a fund for our legal documents because our funds are a little more complicated. We pay boy, $3,000 to $7,000 a year for our investor platform, our software that we work with, that our investors log on to and get all the information and so the deal room and so on. So we've actually paid a lot more than that to run our business. This is a very good deal. We also have an in-house bookkeeper. Of course, we pay her salary now. She manages the bookkeeping of all of our properties. But at the end of the day, that's a pretty affordable price. I was actually surprised when I first connected with TribeVest about a year ago or so at how affordable their service is. Because I know how much this stuff costs. I run a business that does this. And the best part is the costs can be paid by the fund. Right? So you might need to front a little capital here, but of course, you could put that on a credit card or so. That's the, the lifeblood of entrepreneurs. But the cost can be paid by the fund. And of course, that has to be recognized in the legal paperwork and acknowledged upfront to your investors. But that's very normal. That's of course how all of our funds are run and operated as well. You want to keep your costs as low as possible to be fair to your investors and a smart business owner and an entrepreneur. But those funds are really, those costs are really paid by the fund. And of course, it's really a semi-passive position. Okay, once the capital is raised, okay, there is some work up front to make those connections, sit down and talk to your colleagues, explain the investment opportunity. We'll go through that in a minute, how to raise capital properly and efficiently. Once the capital is raised and invested, the most involvement is simply forwarding monthly reports to your investors, which we supply here at People's Capital Group. Quarterly financials, which again are supplied every quarter to you, which you can update for your fund. So you might have quarterly financials for the property and for the fund that you're investing in, but also financials for your own fund, which you would work with TribeVest or whoever your service provider is to get those out to your investors. And then the K1 tax forms. So we send you back a K1 tax form for your fund at the end of the year. And then you send that to your CPA and he'll divvy up the K1s out to your investors. But it's really quite passive once that capital is raised. All the work is done up front, making those connections, sitting down with your colleagues, having those conversations, gauging their interest, closing the investments. And once that's done, it's really a very part-time job. We try to make it as easy as possible to raise the capital, but also operate the fund once you're invested. Okay, let's get into the flow chart for a fund of funds, just to kind of put a visual here so you can understand how the capital flows and how investments are identified here and protected for yourself and your investors. So let's start here in the bottom left, you and your LLC. Okay, so your risk is limited to your limited partner investment. Again, we do encourage you to make an investment in your own fund, kind of put your money where your mouth is, put some skin in the game, as they say, right? And that's going to help you raise capital for sure. We do the same on our ends. So your investment goes into into your fund of funds. You are the GP of that fund, the general partner, the managing member. You raise capital from limited partners, colleagues, and friends and family in your network. The fund expenses are paid from the fund. That fund of funds pays fees and profits back to you. You get your profits split and your fees, as I outlined in the previous slide. Once you raise your capital, you write one large check into the selected opportunity. Now, a fund of funds can invest in multiple deals. It does get a little more complicated if you do that, but that could be a benefit to your investors. You can say, I'm diversified over multiple deals in multiple areas and different asset classes, right? But generally what we see is a fund of funds is created and invested into one opportunity just to kind of keep things simple. Then if you want to invest in additional opportunities, you can create another fund of funds that kind of keeps things simple, right? So then your fund of funds invests in PCG Fund 4, which is the example here, with one large check. And the benefit is you get into a better share class by investing a larger amount. See, an investor coming in directly to PCG Fund 4 with, say, $50,000 would get into the bare minimum share class, the lower share class. That's a lower preferred rate of return and also a less attractive waterfall split. However, if an investor comes in with a $500,000 check or $1 million check, which generally a fund of funds will come in with, well, you get into the better share class. So you might ask, well, why would someone invest in a fund of funds instead of just directly into your opportunity? And the reason is because through your fund of funds, since you're pooling capital and writing one large check, you get into a better share class, which therefore provides a better return on investment to your fund of funds. You can also diversify over multiple operators and multiple investment opportunities in a fund of funds as well. But then the invested capital goes into PCG Fund 4 LLC here. We plan to invest in one property. So really it's a special purpose entity designed to invest in one specific deal, which we'll touch on in the end here. And that's a passively owned investment there by PCG investors. So we'll raise money alongside you. This is about a $5 million raise. Say a fund of fund comes in with $1 million, we'll raise another $4 million. So there'll be additional PCG investors in the opportunity. And then, of course, us as well as the managing member here at People's Capital Group. Then PCG Fund 4 invests in a single property. In this case, we're buying a 66 unit in downtown Newark, New Jersey. It was built about 4 years ago with rents below market value, high vacancies for a Class A building, so nice value add. Beautiful asset. Doesn't really need much work, but it does have rents below market value and a good amount of vacancy, just kind of mismanaged. It is about a 15-minute walk to Newark Penn Station and about 3 blocks to the Prudential Center. So we'll explain more about that towards the end here, but that would be owned by an operating entity that holds the property, holds the debt, collects the rent, pays the expenses, and distributes the net proceeds on a quarterly basis back up to PCG Fund 4, which then would distribute that back to your fund of funds, which you distribute out to your investors and yourself. So how to create a fund of funds? Well, here's how you get started. Step 1, create the fund. First, I would suggest working again with TribeVest, and we can put you in touch with them if you'd like. It's a company that where they're going to start the fund for you and handle all your back office needs. Costs about $5,000 to start the fund, takes about 1 to 2 weeks. Step 2, marketing material. So we actually can offer you editable marketing material for the investment opportunity. This is a professional offering memorandum with institutional level underwriting completed. And these decks cost us about $2,500. They also cost us about another $2,500 in underwriting because we use very high level underwriters that do crazy in-depth Excel models for these deals and do additional underwriting like checking rents and resale values and so on, and all the steps it takes to truly and properly underwrite a deal at an institutional level where, with institutions we talk to that write $25 million checks or so, they expect a certain level of underwriting. So very in-depth marketing materials and underwriting. We put together the whole due diligence folder as well and a deal room. These editable marketing materials are quite simple to work with. They're going to say, put your logo here, put your company summary here, right? Very simple stuff. Everything's all worked out for you. You're going to get an editable PowerPoint where you can essentially just copy and paste into your logo and your company description. And it'll also have information about our company, about our past performance, about the deal itself, the market, the returns, the structure, the business model, and so on, all the financials and all the details that a professional offering memorandum should include. But you can update the marketing materials so your logo can go on it with your fund of funds. And it's very simple to do. It can be done in really a matter of minutes. So we offer you a professional level pitch deck and a 1-page summary. In addition to that, the Excel model and a whole due diligence room as well for you to dig through and make sure it's the proper fit for you and your fund of funds. Step 3, fundraise. Reach out to accredited investors in your network and show them your success investing in real estate and our success working with other people's capital and doing what we say we're going to do and returning people's money on time and on target. Determine if they're fit to invest in your fund, right? And we work with you on this. We do monthly, weekly coaching calls and so on to work with you in this process to make sure you're connecting with the right colleagues in your network and understanding how to do step 4, which is to close. Meet qualified investors one-on-one, answer their objections, make sure they're a fit for your fund, meaning they can invest for 3 to 5 years. They have the liquidity, whether your minimum is $50,000 or $100,000. And this is a good fit for their investment goals, and that you align in the fact that you're going to be the general partner and we're going to be operating the investment day in and day out. Or you want to make sure they're comfortable being a passive investor. And we kind of guide you in how to identify those individuals and work with them to explain the investment opportunity and make sure it's a fit for them. And if it is, then to make sure that they actually are able to invest in your opportunity and complete their investment. Because if you're not closing capital, then you're not raising money. So we work with you to achieve your target capital raise in the allotted time. And in step 5, invest and communicate. So now the hard work is over. You invest in an opportunity with us. You get into that better share class as a fund of funds. You're writing one large check. Then we're sending back one large distribution on a quarterly basis, and then upon the liquidity event as well, which is generally a refinance or sale. We send you monthly updates, which you're going to forward to your investors, quarterly financials, again, forward to your investors, put into your platform. We're going to send an annual K1 tax form to your funds. You get one K1, and then you split that up for your investors with your CPA to get a K1 out to all of your investors in your fund. Distribute proceeds as received using TribeVest platform or whichever service provider you choose. And they're going to help you with those distributions to determine the proper waterfall and distributions to your investors according to your PPM and the structure of your fund, which you want to make as simple as possible, really. Complexity is a sales killer, as they say. So, are you a good fit for a fund-to-fund managers? Okay, do you currently invest passively in real estate? Okay. In fact, let's go in the chat here. I'm curious who here currently invests passively in real estate. If you do currently invest passively in real estate, give me a yes there in the chat. If you don't, give me a no. I'm curious who out there currently invests passively in real estate, because that's a big part of this. People are going to say, oh, well, that's interesting, Bob, you're launching a fund of funds. What's your experience been investing in real estate? Even better if you're already investing with the operator you're going to be investing with your fund of funds. Have you done a number of full cycle investments, right? What's actually been the outcome of your investments? That's going to help you as well. Now, it's not like you have to check off every single one of these boxes, but the more you check off, the more easy and more likely you will to be successful in investing and creating a fund of funds and raising capital. Number 3, your network with high net worth individuals. Some of the most successful fund of fund managers we see is a dentist who knows other dentists, a surgeon who knows other surgeons, people in the tech space, C-suite executives, vice presidents, so on, that are rubbing shoulders with other high net worth individuals. Generally, people that are earning between $300,000 to maybe $800,000 a year or so, able to have that additional liquidity to invest $50,000 to $100,000, who've known you for a while, who know, like, and trust you. Those are the individuals you want to be connecting with to invest in these opportunities. Often people outside of the real estate network completely. The most likely investors are going to be outside of the real estate network completely here. Oops, let me go back. Let's see here. Okay, yep. A couple people do invest here in real estate passively. That's great. Have an entrepreneurial mindset, right? What is your mindset? Do you want to grow? Do you want to build your wealth exponentially? This is your own endeavor. You do want to have that entrepreneurial mindset to be successful at this. Have colleagues asking about your real estate investments, right? Are you at a barbecue or a social event and people are asking about your real estate investments? Are you kind of known as your authority and thought leadership in your network as someone that invests in alternatives and has been successful at it, right? If people know you for that, then you'll be far more likely to be successful in capital raising amongst your network. Do you own a business, right? Again, it goes back to the entrepreneurial mindset. Do you know other business owners? Are you a member of, a business owner group, a mastermind group, right? That has other high net worth individuals with that desire to build their wealth in alternatives also. And do you have capital to invest alongside your LPs? As we said earlier, you don't have to invest in your own fund of funds, but it certainly helps, and it'll certainly create a more stronger likelihood that you'll be successful in your launch of your fund of funds and your capital raise if you're also investing some capital yourself. So, how to successfully raise capital? Well, first of all, it's all about the know, like, and trust. Right? 90% of raising capital is someone has to know you, they have to like you, and they have to trust you. That's generally done through building a relationship in time. There are ways to accelerate that, such as a good marketing funnel, being a thought leader in the space, being referred by another friend. Hey, I know I've known this guy many years. He's one of my buddies. He also is interested in investing in real estate. That, a warm introduction, right, is the best way to be introduced to someone when raising capital. So make a list of high net worth individuals in your network who know, like, and trust you. And that's the first step. And just think really hard. Take your time with that. Try to make that list as long as possible. B, or your B list, make a second list of high net worth individuals who are simply in your network, right? Maybe they're a friend of a friend or a colleague or a coworker or something like that you're really maybe not that close with, but could potentially be interested in what you're doing here. Um, and this might be a way for you to get to know each other a little bit better, a reason to go out to lunch and chat. And hey, you know what? It can't hurt to kind of spread the word on what you're doing, even with people that maybe you don't know that well just yet, but get to know them through this process. And listen, a lot of times people are not going to invest in the first deal. They're not going to invest in the first fund of funds. It's a very, very common situation. And but then over time, they get to know you and like you and trust you. They see you succeed to raise the capital, to get the deal done, get over the finish line. They say, "Oh, that's interesting. That's pretty cool. Maybe I'll get in on the next one." It might take 2 or 3 of those, right? We have people that follow us for 4 or 5 years, see us buy 6, 7 buildings, and then one day they respond to an email. They say, "Hey, I want in on the next one," right? And that's just how it works sometimes with capital raising. It's a long-term relationship process, and people have to know, like, and trust you and see you succeeding in what you're doing. And then they'll want to get in as well over time. Approach with a plan, right? Know your numbers, right? How much capital are you raising? What's the target return on investment? Know your timeline. Right? When will I get my money back? When will I start getting cash flow? When are you closing on the deal? Know the risks, right? Your risk is limited to your investment. You're not signing the debt. You're not responsible day-to-day operations. You're protected through different insurances against lawsuit. Have a plan A, B, and C, right? Maybe have different deals you're looking at or different strategies to raise capital, and know kind of a backup plan if a deal doesn't pan out or something. You're not able to raise the capital in time, right? Have kind of a plan B there as well. Know your why. Why would someone want to invest in your fund of funds? Well, you get into a better share class. You get to diversify out of the stock market. You get tax benefits, 50% tax write-off, right upon investing. Um, know how to invest. Well, here's the next steps to complete the investment. You go right on this website. You get your accreditation form done. It's very simple. Here's how you get accredited. Here's where the wire instructions. Here's all the information you need to determine if this is a fit for you. And here's the timeline, right? When do I need to complete? Well, there is a window of time. These deals, do fill up very quickly, and you want to complete the investment sooner than later, right? Have a deadline. And where, right? Where's the opportunity? Can they go see it, right? Know your numbers. If you're raising capital and someone's like, well, how much of return am I going to make? Well, you might make 15, you might make 20. What's the timeline? Well, could be a year, it could be 5 years. No, you got to know exactly what it is, how it works, and why they should invest with you. And if you're not ready with that, then that's part of working with a good operator who's going to guide you in that process, give you an exact investment opportunity, answer all these questions, the numbers, the timeline, the risks, the plan, the why, how, where, and when. And that's going to help you understand the investment opportunity and raise capital with confidence, because that's a big part of raising capital, is knowing your deal, knowing the opportunity very well, and knowing the operators very well. And that's working with objections off the top of your head, not like reading off a paper on like why or where. And then follow up. At the end of the day, it is sales, right? You want to follow up with these contacts. You want to stay in front of them, phone, text, meeting. One-on-one meetings are the best. Try to schedule a lunch, a breakfast, or grab drinks after work or something like that. um, have professional, easy to understand, yet detailed marketing materials, right? So our decks are easy to understand. We have kind of the summary pages off the bat, but then if you dig into it, by page 20 or 30, you're really getting into the weeds, right? So you can dig in, those more savvy investors can dig into it, see all the analytical slides, but there's also the kind of summary slides as well that the less savvy investors are going to want to go through. So you want to have really easy to understand yet detailed marketing materials. And that's what we supply our fund to fund managers here at People's Capital Group, which again costs thousands of dollars to create in many weeks of time and are done by professionals. And you need to have the right materials to raise capital successfully, and know your investment as well. And that follow up, it has to be consistent, right? If you say that the timeline to invest is by September 30th, and you're thinking you can call them September 29th, that's not how it works. You want to consistently follow up. Think about the best people in sales in your network that are going to consistently follow up with you. Now, there is a bit of a cat and mouse game. You don't want to be too aggressive. You don't want to be nagging someone or seem like needy, but there's a balance between it. I always say it's a lot like dating. You got to kind of be a thought leader in the space. You want to be an opportunity that you don't need them to invest in, but it'd be great if they get in. Oh, by the way, just following up from our meeting last week, trying to make that connection and get to understand if it's a fit for your investment goals. And then handle the objections, right? Boom, objection. I don't know, liquidity, location, operator. Handle the objections, work through them, and then close. But that doesn't happen if you're not following up consistently and professionally with those contacts that are interested in your opportunity. People's Capital Group's fund to funds blueprint. Okay, so we offer a lot of support. You're not just going out there blind and be like, oh, I'm going to raise $1 million, right? There's a process to it. You want to have a business plan. You want to have support behind you to be successful in this. So first of all, easily editable marketing materials. Put your logo here. Put your business summary here, right? We do all the hard stuff, professional level offering memorandum, editable by you, one page summary. One page summary is how you start. You don't want to send someone a 60-page deck off the bat. You send them a one-page summary so you're not overwhelming them. So you see if they're interested. If there's interest, then you can go into the more in-depth marketing materials. The due diligence room, that's more for you. You're going to want to click around in the due diligence room, get familiar with the deal, make sure it's a fit for you and your fund's investment goals, and get well versed in the deal. Earn your due diligence fee, right? We put together tons of due diligence documents that pass the smell test from family offices writing multi-million-dollar checks and large fund of funds that have endowments from pension funds that are required to do a ridiculous amount of due diligence. So our due diligence room is institutional level. You'll have access to that. It's not necessarily the best place to send your investors unless they want to go poking around. It's really more your job to go through the due diligence, summarize it, make sure it's the right investment opportunity for you and your fund, and then bring that back to your investors in a nice, editable, easy to understand manner that they can understand the investment opportunity. Institutional level underwriting, again, we have very in-depth Excel models. You're going to want to just peek out to understand the details and go through in as much in depth as you'd like. And then the webinar course we make for every single offering, which some people learn best through video. So we do about a 45-minute webinar for each opportunity, which will help you understand the deal, but also your investors as well, if that's how they learn. Weekly coaching. So we offer ongoing support. This is all free. We do a 1-hour Zoom meeting with all our fund to fund managers with real-time guidance and problem solving, right? I mean, you're all going to be coming up with a lot of the same issues. That's what we find, right? Oh, this objection here. Oh yeah, I had that objection too. Here's how I handled it, right? I've been raising capital for 13 years. I've raised about $20 million. I've handled a lot of objections, a lot of challenges in the way. So I try to work with all of our fund to fund managers to get through that. So we do a 1-hour Zoom meeting every week to go through it. I try to be very available to our fund to fund managers to support you in this process and help you handle all the challenges you'll face fundraising for your fund to funds. Fund to fund manager profit calculator. So we have a calculator you can use to estimate exactly how much you should expect to earn on the capital you raise. A $1 million raise for a 5-year investment should equate to about $150,000 profit for a fund to fund manager. Okay. Support from TribeVest. We suggest TribeVest. They're not the only service in town. There's also Avestor. There's a few others as well. I think TribeVest is the best return on your investment. They seem to be the most affordable and very professional as well. There's also Avestor, but I think they're much more expensive to start with. Um, so startup support, you can launch in 5 days, everything you need to get going for $5,000. Again, that fee is paid by the fund once you start raising capital. Back office support, including K1s, onboarding, banking, offering docs, ongoing client services, and dissolution of the fund as you close out the investment upon that final liquidity event, which is the day we all love in real estate investing. And fundraise guidance, right? They have lots of videos on how to raise capital and how to do your fund to fund. So not only are you going to get guidance from people's capital group, but you're going to get guidance from the right support company as well, which TriVest offers a lot of educational videos on that also. And distribution and bookkeeping services as well. That might be a little bit extra, but that's a good service to hire, and they're going to help you with the proper distribution and bookkeeping for your fund. Again, all these fees are paid by the fund itself, and they're very minute. They're very affordable for what you're getting. We pay much more for these services, but we do run a number of funds and have about 25 properties, so it's a little different. Consistent communication. PCG will send you monthly reports and updates, quarterly financials and distributions, annual K1 tax forms. So we take care of everything from A to Z. Once, of course, the deal is closed, the capital is raised, all the work is done up front in the process of raising capital, and that's where we really guide you. And then, quite frankly, once you have a fund that's successfully raised and closed on a deal, it gets a lot easier after that. People's Capital Group. So, by the way, this is 105 Marion Street in Paterson, New Jersey. We plan on selling this asset here in about a few weeks and achieving our return targets to investors. Nice brick face. There's actually an old warehouse that was converted into nice condos, like loft-style condos with big windows and nice building there. We purchased about 5 years ago. So we'll be achieving our target returns to investors on that building there. So differentiated approach here to investing. So we really focus on alpha generation. We want to find value add opportunities, which is what we have on a contract right now in a real estate market that is kind of small for larger institutional groups, but large enough for our funds. We buy properties between 50 to 150 units throughout New Jersey. That's our target market here within an hour commute to Manhattan that have rents below market value and are needing improved management. Skilled deal sourcing. So Seth and I have done about 280 transactions here in New Jersey. Our main strategy is to source off-market deals at discounted prices from our networks of brokers. We get out there first. We submit an LOI on good deals. We'll underwrite about 100 deals to buy one. We know a lot of attorneys and wholesalers, developers, landlords, and we buy all of our deals off market. Vertically integrated in-house property management system here, about 20 different independent contractors that work under us, leasing team, and so on. So we have a nice boots in the ground, vertically integrated infrastructure to make sure our projects are completed on budget and on schedule. And an investor-first approach. So how do we select out of 100 deals the one we want to move on? It's all about the return on investment to the investor and the risk profile, right? And these things like rent control and so on. We want to understand the deal and the risks involved in the deal, the amount of repairs to do to a property, permits, and so on. And how much is the town going to get involved? All those things are taken into account. We want to get the best return on investment for our investors, taking into the risk calculated in the deal, and really go for the best, lowest risk and best reward for our investors. Some past performance numbers here. Our average rent roll increase per year is about 8.6%. Average annualized cash on cash return, or AAR, is 15.1%. 12 completed syndications, 83% investor reinvestment rate after liquidity event. And you'll find the same. If you do well for your investors in your fund to fund, you perform as you say you're going to perform. You do what you say you're going to do with other people's money. People will reinvest, right? Why are they going to go risk their investment on a new operator? Or, if they're satisfied and you're hitting the targets, well, then you'll find that, you distribute cash out to investors. The only people that really aren't investing on our end are active operators that say, well, I have another deal I want to get in on. Or they're kind of at the age of retirement and they're like 75 years old and they're not going to get in on another, 5-year non-liquid investment because they just don't think they'll be around when the investment sells. So kind of more unique personal situations, or they started a business, they want the money for a business, or something like that, or they need the money for a business they're operating right now, just more personal uses of the money. That's generally why we see investors not reinvest. But the majority, almost 85%, do reinvest because if you do what you say you're going to do with other people's money, they tend to be satisfied and reinvest in future opportunities. And here's our management flow. That's me on the left, capital raising, debt and equity structuring for our equity deals. Seth Martinez, my business partner here for over 12 years. We've really focused on building a good business here. Seth handles the operations. He's managing the debt fund. He's doing smaller acquisitions like fix and flips. We buy land. We get it approved for building on and sell to builders. We buy small multis. We refinance out of those or flip those. Seth works with our management company. Lena heads our management company there. We have a number of independent contractors and employees under her. We have about 20 construction contractors going at any time. On the capital management, we have Dana Sargenti, who makes sure our bookkeeping is done properly and our distributions go out properly to our investors and our K1s, so on with our CPA, the Robert Grulich. On the marketing side, a number of virtual assistants and employees that help us to make sure we get our podcasts out, our webinars done properly. There's Matthew Ciancini, our underwriter, institutional level underwriter that makes sure our buildings are underwritten properly and efficiently to pass the smell test for institutional level underwriters. So we have a robust team here to make sure we're able to find and source great opportunities, underwrite them successfully, raise the capital successfully, and invite other qualified investors to invest alongside us in these opportunities. And then, of course, execute on the business plan over a 3 to 5 year period to reposition the building, make it a nicer place to live, increase the revenue, and then harvest that equity growth over time through refinance or sale of those assets. Here's our 5-year plan here. We recently bought a 42 unit at the end of 2024 in Passaic, New Jersey. That building is on target. It's returned about $45,000 or so in cash flow to investors so far. About $40 million AUM at this point. We are refinancing some buildings in beginning of 26 here. We're selling a building next month, a 25 unit. I'll show you the picture of in the previous slide. We plan to raise about $10 to $20 million this year and acquire $20 to $40 million in assets. 2026, we'll be refinancing one large building that's ripe for refinance. We'll be selling another building. We plan to raise about $25 million and acquire about $50 million in assets. We have a number of institutional level groups we're talking to right now. We're working about a $25 million allocation from one and about a $10 million allocation from another. In 2027, we plan to raise about $50 million and acquire about $100 million in assets and refinance or sell a couple more buildings. And in 2028 to 2030, we'll begin really harvesting a lot of those assets that we've bought over the years here and getting into those liquidity events, which is the point everyone loves. It's a fund-to-fund managers. It's nothing like getting a big check in your pocket from the sale of an asset. So here's our next asset. It's the Williams House in Newark, New Jersey. This building is actually a mismanaged building, and the owners are quite motivated. If you could see this building here, this kind of partial building with the second half is black and the bottom half is brown. That building is a luxury condo development, 90 units they're developing right now. They're working on getting their C of O, and they're in trouble on it. They're behind on the mortgage, and they need to sell the Williams building, which is across the street, to kind of help that development. So they're motivated sellers. In addition to that, the Williams building is mismanaged. They hired the wrong management company, so it has rents below market value by about 12 to 15%. It has a high level of vacancy by about 12% as well, which is kind of rare for a Class A building. It's built 4 years ago, brand new building, beautiful luxury asset. 3 blocks to the Prudential Center. That's where the New Jersey Devils play. About a 15-minute walk to the Newark Penn Station, which gives you a path train ride into Manhattan in about 18 minutes. Or you could walk right up over here and jump on the light rail, take that one stop, and you'll be at the Newark Penn Station there in just a few minutes or so. It's about a 30-minute commute into Manhattan and very close to the Prudential Center, right in the heart of downtown Newark there. And, we've really seen a renaissance. You could see all the retailers and restaurants listed here on the left, on the right, of all the companies that have come in here. A lot of large companies. There's Red Bull Arena, I believe. There's a World Cup game going on there. There's the Prudential office building that kind of kicked off this renaissance in downtown Newark about 15 years ago. This building, there's no deferred maintenance. It's a brand new building. It's 4 years old. It's just improved management that we need to do to the building. So we'll come in with our in-house management company and improve the management of the asset, get it leased up properly, bring rents up to fair market value, increase additional revenue streams on the building through amenity charges and storage and so on, and lease up the building to ideally 100% occupancy as well. So Newark, New Jersey, if you haven't kept an eye on it through the years, by the way, in the chat, has anyone invested in Newark? Put in the chat if you've invested in Newark, New Jersey. I'm curious to see if you've ever invested in Newark. So let me know in the chat. Have you invested in Newark? Have you invested around Newark? I know East Orange is hot as well. But a lot of people are saying it's the next Jersey City. And so that is what we're seeing here. You know, a lot of growth. You have the Prudential Center. This is 3 blocks away from the Red Bull Arena, New Jersey Performing Arts Center, the NJ Pack, and oh, thank you, Gail. Appreciate that. Is a great area as well. Prudential Center is $375 million complex. The Sports Illustrated or the Red Bull Arena is about a $200 million stadium there as well. And the NJ Pack, there's a nice area, about a $190 million asset that a lot of shows are at. You go there to see a play or something like that, or a musical performance. You have the light rail that goes throughout Newark, New Jersey as well. Rutgers University, a number of universities there. Just a lot going on in Newark, and we're right in that downtown area. You know, 3 blocks of the Prudential Center, not far from Riverfront Park there, and just that area that's really booming. There's nice restaurants. It's actually a nice place to go out. And it's really, you know, a completely new experience, a new area than it was 15 years ago, where you might not feel comfortable going out to dinner after the sun goes down in downtown Newark. Now you really do. It's a nice area to go out, and there's a lot of new construction going on. And this is a motivated seller. We can buy a mismanaged asset that was built 4 years ago for a discounted price. So here's the proposed timeline we're looking at. We're going to be placing this property under contract, going from LOI to purchase contract in September. Then we're going to be collecting in LP investment commitments over that time, wrapping that up in October, completing our due diligence by November, and moving to completing our loan commitment in December and closing shortly thereafter, ideally by the end of the year, December 2025. By January 26th, we target quarterly distributions to begin. The money, by the way, is held in a high-interest savings account with PNC Bank, a money market account, and earns about a 3.8% interest rate. So as the money sits prior to closing, and you could do this too with your fund of funds, of course, have a high-interest money market account. You know, if you're pulling $1 million and it's sitting there even for a month, you know, that's a couple $1,000 in interest you'll be earning, right? So that's great. And we do the same thing, and that interest is distributed out to investors. So distributions begin there in January, continue on a quarterly basis through the life of the investment. By January 2028, about 2 years in, we expect to have the asset stabilized, you know, up to full lease up, bring those rents up to market value. Again, there's not much in renovations to do. Really, all we're doing as far as hard costs is the building has a kind of a plain gym. The gym is kind of lackluster. We're going to make it a much nicer gym, better machinery, a little more decor and so on there. Improve the work room. There's like a work from home room. We're going to just make that a little nicer. But really, for the most part, it's just improved management. So we're looking at maybe $100,000 of CapEx in the building. Again, it was built 4 years ago, beautiful brand new asset. We'll bring it up to stabilization over a 2 year period. Then look to sell the asset by year 3 and have a liquidity event. So this is just a 3 year investment. It's not a long-term investment. That's going to make it a little easier for our fund-to-fund managers to raise capital, because generally people don't want to invest for longer than they need to. So by doing a 3 year project here, it's generally an easier sell than doing a 5 year investment or a 7 year investment. So we do expect quarterly distributions to begin by the end of January and to continue through the life of the investment. And then we'll have the final liquidity event 3 years in, ideally where we have a nice exit on the asset. So that's it for me today, ladies and gentlemen. Please put your questions in the chat or the Q&A here. Again, this presentation was focused on how to create a fund of funds, which hopefully you recognize is actually easier and more affordable than you may think and can be done in 1 to 2 weeks for about $5,000, which your fund would actually cover the cost of and allow you to, yes, put in some work off the bat, but we are going to make it as easy as possible for you with editable marketing materials, weekly coaching calls to guide you, connecting you with a good company like TribeVest to help you start and manage the whole back office of that fund so you do as little work as possible and just take advantage of those relationships you have with people that know, like, and trust you that are high net worth individuals that are saying, hey, you're invested in real estate. How's that going for you? How's the real estate market? Are you a thought leader in the space? Do people come up to you and ask you about the real estate market, right? Do they ask you about alternative investments? Do you have people in mind you're thinking of right now? That friend of yours that owns a few restaurants or that C-suite executive, they might be perfect for what you're doing. And hey, it doesn't hurt to ask, right? Just be kind and professional about it. But a lot of people are going to be very receptive to this and say, it's interesting. I've always wondered about real estate investments or about your real estate investments. I know we talked about it a year ago at a barbecue and seemed pretty interesting, and I'd like to learn more about what you have going on. Be prepared when you have that conversation. You have a plan, connect with us first. And what I'm going to do here is I'm going to put a link in the chat here for you to schedule a call with me directly. Now, normally I have people schedule a call with Patrick, our client relations manager, but I'm going to put a link here to schedule a call with me directly, Aaron Fragnito, and that way we can talk about the fund of funds here and if it's a goal for if it fits your investment goals here. So, all right, so there's the link to schedule a call with me, Aaron Fragnito. And thank you for everyone who's participating here on the chat. I appreciate that, Gail. Thank you very much for that testimonial in the chat there. And can't get much better than that, right? And that's what it's all about, is working with people that are satisfied with you and know that you run a good business and do good business. So once you have that reputation, or just the reputation of being a thought leader, being someone that has integrity, even if you haven't raised capital before, you're not in the capital raising space, but you are known amongst your friends as someone with integrity. People come to you with issues, my kid has this issue or whatever it is, financial issue. It doesn't even have to be financial. People just come to you with their problems and seek advice. Well, listen, that you're a thought leader in the space. You're someone that they're seeking advice from. And chances are, if you come to them with an opportunity that's well vetted, that you understand, that you have passion behind, they're going to see that and they're going to want to partake with you alongside you in that opportunity. And that's the beginning of creating and launching a fund of funds and being successful in this venture. The first one's the hardest. We're going to help you get it off the ground. We'll work with you on weekly coaching calls, give you all the marketing materials to get started as well. So it's very easy to copy and paste in your information and all the underwriting done for you. So you can go through it and make sure it's a fit for you and your partners there on your fund. So the link to schedule a call with me is in the chat. I don't see any questions here in the Q&A, so that means I did my job pretty well. And but let's schedule a call. Let's understand your investment goals, any questions you have, and let's raise capital together and buy some beautiful real estate, especially this nice $23 million asset in downtown Newark, 66 units, mixed-use building built 4 years ago, Class A building. It's really a beautiful asset. So if you want to learn more about that, even on the LP side, you can schedule a call with me there. We haven't launched it out yet. You haven't seen any emails about it because this is the first presentation we're doing about it. So if you want to learn more, click the link in the chat, schedule a call, and let's see if this is a fit for your investment goals. And let's talk about creating a fund of funds as well. See if that's a fit for you also. Thanks a lot, ladies and gentlemen. I'm Aaron Fragnito with People's Capital Group. Have a great night.